Let's first start with the bull case. Walk us through the bull case.
The bull case at this point, just going back to what the Fed is doing, they're creating a tremendous amount of money in the economy. And very few of those dollars are being used to actually buy goods in the economy. So what you have is what's called excess liquidity. A lot of money is being created and nobody's using it to buy actual real goods. So it's got to go somewhere. And that place is financial assets. And so that's the biggest key to the bull case. And so you think, that phenomenon has fueled this initial rally, but there's still plenty of cash on the sidelines. And you don't really need any type of a fundamental driver to get stocks to just drift higher from here. This rally can feed on itself, and a lot of that cash on the sidelines can come back into the market as long as the Fed is doing what they're doing and supporting markets. So that's a key component of the bull case from this point.
And we've seen a lot of the rally has been highly concentrated in a handful of names, and a lot of stocks really have not participated in the rally. So maybe talk a bit about that divergence.
There's definitely a divergence. If you just look at where stock prices are right now, a lot of the largest companies in the S&P 500 index are within shouting distance of all-time highs. It's almost like this never happened for them. So they have been beneficiaries of a lot of money just coming back into passively managed investment products. You think if you look at the S&P 500, names like Apple, Microsoft, Google, they're all such large weights in the S&P 500 index that they're just benefiting from broad flows into passive products. And on the other side of the spectrum, if you look at small caps are down close to 50% from February 20th through March 23rd. So just, getting absolutely ravaged during the market downturn. We've seen them rally about 30%. They haven't been beneficiaries of a lot of this liquidity. What they have started to benefit from is insider buying. Executives, CFOs, CEOs, a record amount of insider buying for small caps. So we are seeing that bigger divergence in terms of stock prices, but it's important to note we are starting to see some signs of life in the small cap area as well.
That's great. So let's move from there and discuss the bear case. Walk us through what we might see there.
So the bear case, given that what's been baked into prices has been, we're going to be living with this virus for an extended period of time, and a resurgence of cases in the fall is already baked into our base case. You'd have to have something much worse on the virus side for the bear case to develop. So you think if vaccine testing continues to fail, if we reopen and we get another gigantic surge in cases, this thing mutates, those are all elements of the bear case. But something more sort of visible and sort of the opposite of the bull case is that what the Fed's doing, if it works so well that they feel like they can stop or they should stop, that would be a serious problem. If you look at stocks right now, the S&P 500 is trading at 22 times forward earnings. That is the most expensive since the tech bubble. And that is driven by this idea that the Fed support is going to be there. If the Fed starts to get sort of full of themselves and think, hey, we've done it, and they declare victory and they start decreasing the size of their programs, a lot of those gains could be erased pretty quickly.
And just from a perspective standpoint, the Fed probably isn't going to stop when unemployment is at 23%. They're probably going to wait until unemployment has reach back down to the levels it was pre-crisis. Would that be a correct statement?
That's exactly right. I mean, they're not going to look at the S&P 500 near all-time highs and say, yeah, we should reduce our bond purchase programs given that unemployment is over 20%. They're going to live with stock prices at all-time highs. They're fine with that.
Okay, so let's talk about the base case. What do we think here at CapStrat about what the most likely outcome is going forward from here?
Well, if you have any sort of valuation discipline in your process, which we do, and you look at the S&P 500 at 22 times forward earnings, and you're already at or near your long-term equity targets, it's tough to justify moving to overweight. just looking at that situation in a vacuum. And for that reason, we think it's quite possible that the market basically consolidates a lot of these gains that we've had in late March and early April. You're going to have a confluence of factors where the Fed's going to keep doing what they're doing, and you're going to see more and more news about reopening, and that'll be on the positive side of the ledger. But on the negative side of the ledger, you're paying 22 times earnings. Earnings expectations are still falling, and so that's very expensive. And we're going to be dealing with this situation for an extended period of time. You're going to have more bankruptcies. So, the base case from here is you say we sort of consolidate, elevated volatility, trade in a range, most likely just grind higher in terms of the equity market until there is some type of clear resolution on the virus front.
And in that scenario, from an investment standpoint, we're looking at purchasing higher quality dividend paying stocks. We're looking at safer, more liquid investments. Is that correct?
Higher quality dividend payers, or on the other side of the spectrum, very large growth companies with a tremendous amount of cash on their balance sheets who are going to gain market share in this environment, and their businesses are somewhat less impacted. Those are the names you want to be focusing on. Taking a flyer on some of the small cap names after they were up 30% during April, you're probably a little late, and there's a lot of risk.